Let's move on to options. And before starting off with what are options, we have done futures. And what do we know about future contracts? That both buyers and sellers are obliged to honor their positions, right? But in options, option contracts are a bit different in the sense that option contract gives the buyer the right but no obligation to fulfill his or her side of the position. So option gives an option to the buyer of the contract. When we say buyer of the contract, we mean to say the person who holds the option, the person who's buying the option. So when you are buying the option, if you wish, you can exercise your option if it is favorable. If it is not favorable, you can decide not to exercise the option because you don't have any obligation to exercise it. All right. Now, when we talk about right can be of buy and sell. So, there could be a person who is buying the option to buy, the right to buy, or the right to sell. When we say right to buy, it is known as the call option, and right to sell is a put option. What we are saying is that a call gives the holder the right to buy an asset at a certain price within a specified period of time. And calls are similar to having long positions on stock. When I say I'm long on a particular stock, I'm saying that I'm buying that stock. So calls are similar to having long position on a stock. Buyers of call hope that the stock will increase before the option expires. And what does a put do? Option gives the holder the right to sell an asset, the right to sell. Call option was the right to buy. Put option is the right to sell. Who has the right? The person who's buying the option, the buyer of the option, the holder of the option. So, coming back, a put option gives the option holder, the right to sell the asset at a certain price within a specific period of time. Now, puts are very similar to having a short position on a stock. So, what is a buyer of a put option hoping? He's hoping that the price of the stock will fall before the option expires, and thus he's entering into a put option, right? Now, if you look at this point here, let's again define the people involved in a option contract, right? So there will be two parties to any kind of option contract, which is the first party holder, second party writer. Holder, writer. Who is the holder? In any option contract, holder would be the person who has the right. This person is the person who's buying the option. And who is the writer? The writer is the person who has the obligation but no right. So, two parties, holder, writer. We also call them buyer or seller of the option contract, right? Now, they could have the contract to either buy or sell, which is call or put. So we have call buyer or call holder, we have call seller or call writer, we have put buyer or put holder, put seller or put writer. Call buyer means call holder, the person who has bought the right. This person has the right to buy. Call means buy. And if this person wants to exercise his right to buy, if the conditions are favorable to him in the market, then the party who wrote that option contract, the call seller or the call writer, will have the obligation to sell. The writer cannot say that I don't wish to sell now, because the writer is always under the obligation. The writer foregoes the right, and the right foregoes the right to whom? To the holder, right? So call seller will have obligation to sell if the call holder wishes to exercise his or her right to buy. Looking at put buyer, put holder, this party has the right to sell, and the counterparty to put holder is the put writer, will have obligation to buy. You understand that writer is foregoing his right, and the right is received by the holder or the buyer. You would also know that no right comes free of cost. So the holder or the option buyer has to pay a premium to the option seller or option writer for that right, for availing that right. So premium is paid by the option holder to the option writer, and it is an upfront cost to the holder and immediate gain to the writer of the option. That's what we are saying here, that buyer is purchasing the right, he needs to pay the cost of that right, known as premium, upfront to the option seller. Moving forward, we have these option styles based on when does an option expire. We could have two kinds of options, American option or European option. Now, American option is one which can be exercised at any point till the date of expiry or up to the expiration date. While under European option, you can exercise your right only on the expiration date. So it's very much clear to you that American options provide more flexibility to the holder, because they are saying that the option can be exercised anytime until maturity. And obviously, if there is more flexibility in American options, you would know that that becomes the reason why American options have higher option premium in comparison to European style options. In India, all options on individual stocks are American. That means you can exercise your right anytime until maturity, while all index based options are European, where the right can be exercised only on the expiration date. So, based on expiration date and when can be exercised, we have American and European options. Then we have other options, another set of differentiation, and we can say that we have some covered options and naked options. Now, covered options are contracts sold by traders who actually own the underlying shares. So, when you're entering into an option trade and you already have the underlying security for which you are writing the contract, then you have a covered option. In contrast, naked options are those where the writer does not own the underlying assets, and thus they are unprotected from unlimited loss. What we are saying is that naked options are a kind of option strategy where trader who's a writer, or you can say a seller of call or put option, does not have enough cover or enough protection or enough hedge for the position against adverse movement in the price of the underlying. You know that the writer of the option can either write a call option or a put option. So that person would have a either a naked call or a naked put. It's also called uncovered, or you can also call, so naked call is also called uncovered call, it's also called short call option, and naked put also is called uncovered put, also called short put. So what happens when you are selling a call option? Selling a call option means the seller of call option, the writer of call option, has the obligation to sell assets, but no right to opt out if the buyer exercises the right to buy. We just saw in the previous slide. Here, if you see, if you're writing a call option, right, you're short on call, you have a obligation to sell if the holder of the option, of the call option, decides to buy. You cannot opt out. And here, if the seller or the writer of the call option does not hold the asset in physical form, it's called naked call option. And the risk of losing money is very high in these kind of options. What is happening in a naked call is that the trader has sold the right for something which he does not own the underlying in physical form. So why would somebody enter into this kind of strategy? It's a bearish strategy, first of all, naked call, and the only objective is to earn option premium and exit. And now if you take example of naked put, I'll just show you this only. Let's say when a put option is sold, right? The writer is the writing a put option. What does it mean? That means the seller of the put option has the obligation to buy assets, but no right to opt out if the buyer of the put option exercises his right to sell. Now, if the seller of the put option, the writer of the put option, has no intention of buying the physical asset or forgets to offset the trade in the market before expiry, it is known as naked put option. And again, here you would have a lot of risk of losing money. Naked put options would be disastrous if the prices drop significantly, because obviously if the prices drop significantly, then the holder will exercise his right to sell and the writer will be in obligation to buy. So this is not suggested unless and until somebody does not have excessive cash margin. And when you talk about naked put, it is a bullish strategy where the only high point is to earn option premium and exit. So that is about naked options. Let's move on to here and see what do we have here. I'm going to tell you a bit about the terms that we often use when we are talking about option contracts. So the first term that we use is the strike price or the exercise price. This is the pre-agreed price at which the stock can be bought or sold, right? Upon exercise of the option contract. So this is the price, the strike price or exercise price is the price on which the contract, if executed, because obviously in options the right remains with the holder. If the holder of the option, be it be a call option, be it be a put option, if the holder decides to exercise his right to buy or sell, then it will happen on this strike price or the exercise price. This is a pre-agreed price. So irrespective that what is the price in the market, the contract will be executed on this price. Then we have the term premium, right? What is the premium? Premium is the amount, option premium or option price amount paid by the holder of the option to the writer correct? And the total cost of option, or the total premium of the option, is determined by six variables, which are stock prices, exercise price, volatility, time to expiration, interest rate, and dividend payouts, which you can see out here. I'm gonna just explain them to you one by one. And if you look at expiration date, what are we saying? That this is the date, after this date, the contract ceases to exist. So you can no longer trade on any exchange or exercise the right that comes with the contract. So this is when the contract expires. Just to throw some more light on the strike price. Now, when you remember, when we were going for a call option, when a call option is exercised, why would somebody want to exercise their right to buy? Because probably the asset's price in the market has gone way too high, and I had decided on an exercise price which is lower than the price in the market today. Then I would be in a better off position, and I would probably exercise my call option. Correct? So here, when I'm saying market price is the spot price. In case of, let's say, put option, a put option is exercised when the stock stock's price is lower than the exercise price. So holder of put option can sell the stock at exercise price which is higher than the prevailing market price. You don't have to get confused with the terms strike price and spot price and when which option is exercised or not exercised. Only simple logic. If you're on the buying side, you want to buy things at the minimum rate. If you're on the selling side, you want to sell things at the highest possible rate. From a buyer's point of view, your fear is that the market prices will go up and I would not be able to buy the stuff for a cheaper price. And thus you fix a exercise price which you think is reasonable enough because you're expecting that the market prices will go up. And if the market prices go up, you will definitely exercise your right. You will definitely buy that product at your agreed upon price. And if you talk about it from seller's point of view, the fear is that the prices might go down and I want to be able to sell my underlying asset at a higher price. So I fix that price today. I make it a pre-agreed price. That becomes my exercise price or the strike price. And tomorrow, let's say if the market actually goes down, then uh, I am in a favorable condition and I can exercise my contract on an exercise price which is much higher than the price in the market. So simply think about it from the perspective of a buyer and seller. Think what is their aim, think what is the risk that they face, and think that if they have a pre agreed price and the market reacts in a certain way, then how would each party behave? When you start thinking that way, it becomes much simpler. Now, before coming to factors affecting option premium, I want to go to the next slide and then come back to this one. All right. So, this is basically the structure of how the option price, at least the theoretical option price or the option premium, is calculated. Okay. So, option price or premium can be considered as sum of two specific elements, which are intrinsic value and extrinsic value. Okay. Extrinsic value is also the time value, which, so intrinsic plus extrinsic gives you the option value, and this is the formula that is the Black-Scholes formula, which is used for decades in financial industry to estimate the value of option contracts. So, going a little deep into the formula, intrinsic value equals the extent to which the option is in the money already. Now, you would ask, what is in the money? There can be three things with an option. Either the option can be in the money, or out the money, or at the money. Simply putting it, when I say in the money, that means if I exercise the option, then it is beneficial for me to exercise and I will make some profit out of it. And when I say out of the money, I'm gonna make losses now. And at the money, it's a break even point and uh, does not make a difference. Indifferent whether you exercise the option or not exercise the option. Obviously, in the upcoming slide, somewhere I have a slide dedicated to moneyness of options. But as of now, what you have to know is that intrinsic value equals the extent to which option is in the money already. So I'm not waiting for the expiration date. I'm saying today I've entered into an option contract. The spot price is something and my exercise price is something. Am I in the money already? If let's say I buy a call option and the spot price of that underlying asset, that means the price at which that asset is available in the market is say rupees 20, and the strike price is, let's say, rupees 10. So I am obviously already in the money. I can exercise the option right away if it is of American style, and I can make a profit of 10 rupees because something which is available in market at 20 rupees, I can buy that same thing for 10 rupees. So amount that the option is in the money already. Intrinsic value of an option is the amount an option holder can realize by exercising the option immediately. Thus, intrinsic value will always be positive or zero. And out of the money option will have zero intrinsic value. Right? So, if let's say I want to understand intrinsic value of in the money call option, what will be the intrinsic value here? The market price minus the strike price. The example that I just gave you, that in market something is available for 20 rupees and I have a strike price of 10, I can buy that for 10. Then 10 rupees is the uh, profit that I'm making, and that profit is called intrinsic value if you exercise the option immediately. And if you talk about intrinsic value of in the money put option, the intrinsic value will be strike price minus market price. Right? Why? Because let's say that in the market something, the underlying price is, let's say, 50 rupees, and I have a strike price of 100. That means I can sell it at 100, whereas in the market it is available for 50. I will obviously exercise my put option. I will obviously sell it at a higher strike price. So that the difference between 100 and 50 is the intrinsic value. Okay, and intrinsic value is basically affected by your spot price and your strike price. Spot price is also called your current price. Strike price is also called your exercise price. Correct? If you look at the extrinsic value, extrinsic extrinsic value is the remaining value of an option. the time value of an option is the value over and above the intrinsic that the market places on the option. Now, there are multiple factors that will affect the time value. These will be your time left until expiration, the expected volatility of the underlying product price, and little less important factors like your interest rate or your risk free rate and cash flows of the underlying, like expected dividends. So, what we are saying, extrinsic is over and above the intrinsic. So, what is the formula for extrinsic value or time value? Option price minus intrinsic value. Correct? That's what we are saying. Now, coming back to, so if you see, I have, before going back to the previous slide, if you see, I have two factors here affecting the intrinsic value of the option premium. I have four factors here affecting the extrinsic value or the time value of the premium. So in total, six factors. If I come here, you look at the factors here, these are exactly those six factors, and these are the factors that are affecting the option premium. Now let's see how do they affect. So stock price or spot price, this is the level of existing spot price relative to strike price, and higher the spot price, the higher will be the call option price. Correct? And negative or inverse relation with the put price. If you talk about exercise price or the strike price, options that are in the money, they will have higher values compared to options that are out of the money. When a call option is in the money, it means stock price is higher than the strike price, while a put option is in the money when a stock price is less than the strike price. If you look at the time to maturity, time to expiration, so what we are saying here is that time has value, and the longer the option has to go until expiry, the more opportunity there is for underlying price to move to a level such that the option becomes in the money. So generally, the longer the time to expiry, the higher is the option's value. And as expiry approaches, the value of the option becomes zero and the rate of time value decay accelerates. There's a concept of time value decay. So basically, rate of time value decay is accelerating. So logically, if you see, what we are saying is that more time you have, there's a higher chance that you are right and you make money. Therefore, options with more time left until expiration are more expensive. So here you see both the options have a positive relationship. Increase in time to expiration is increasing the call price and also increasing the put price. And same goes for volatility. Only time to expiration and volatility have these direct and positive relationships if you look at the table. Volatility, what is volatility? Volatility is measurement of risk, uncertainty. So volatility of an option is a measure of the probability of the price movements of the underlying instrument, variability of the average prices or standard deviation. So more volatile the underlying instrument, the greater the time value of the option will be. Volatility does not measure the direction of the price change. This means that the greater the uncertainty for an option, the seller will ask for higher premium. He will ask to be compensated more. So the option price increase as volatility increases and decrease as volatility falls. Correct? What is left? If you look at the, okay, so I said risk-free rates or the interest rates and the cash flows like dividends are little less important, have small effect on the option premiums. So these two parts, the risk-free rate and the dividends, they reflect the cost to carry shares in an underlying security. What is cost to carry? Cost of carry is the potential interest paid for or received. If whenever you have risk free rate, you mean the T bonds are in picture, you mean that we are trying to take out the present value, you already know that. So just listen to what I'm saying that cost of carry is the potential interest paid for or received from alternate investments like your T bills, and the dividends from owning the shares outright. So pricing takes into account an option's hedged value. So dividend from stock and interest paid or received for stock positions used to hedge options are also a factor. And you can see the relationships that they have with the call or the put option. Let's move ahead. Because we have done this with this slide, let's go to this slide now. Here, through this slide, I'm gonna reiterate my points, which I've already told you, because I want you to be very clear with things. So what are we saying? That what are the rights or obligations of the call holder and the call writer, right? So in case of call options, the right to exercise is with the person who is holding the option, the call holder, and the person who's writing the option, the call writer, will have the obligation. When we are talking about call, that means to buy. So the right, if the right to buy is exercised by the call holder, then the call writer will have the obligation to sell. Also, what we know is that call option buyer pays the option premium to the option writer or the seller, right? And that premium is paid upfront. So what we are saying, in one option contract, there will be two parties, right? So one party would be long the call, the other would be short the call. It's just different terms that we're using. Long and short means the same thing that we have discussed in the previous slide. Here what we are saying is that the buyer, the holder, is assuming the long position and the seller of the option assumes the short position. So person who is long on call has the right to buy, and person who is short on call has the obligation to sell. I'm just acquainting you again with the terminology and just clearing up things for our upcoming slides. Let's quickly have a look at the put holder and the put writer. What we are saying, in case of put option, we'll have two parties, a party that is long the put and a party that is short the put. Who is long the put? The option holder or the option buyer, the person who has bought the option for put, the person who has bought the option to sell is long put. Who is short put? The writer of the option or the seller of the option, the person who is selling the option to sell. Clear? So again, the person who is long will always have the right, the person who is short will always have the obligation. The right to sell. Put means sell. So the right to sell, and here what we are saying, the obligation to buy. Again, the option buyer, the holder, the person who is long in the contract. So person who has long put will have to pay the premium to the option writer, the person who is short the put, and this person receives this premium to perform his side of the obligation, right? I told you about moneyness of options. I told you that there could be three things: in the money, at the money, out of the money. When we were talking about intrinsic value, we were saying intrinsic value is the amount that the option is in the money. So let's come back and see what we mean by in the money. Relationship between the strike price and current stock price. Call option would be in the money if stock price is above the strike price, and put option would be in the money if the stock price is below the strike price. Simply said, I have stated it before also, but simply said, if I have the call option, then I want, and I have a particular strike price, I would want that the prices in the market go much higher so that I can buy at my price which is much lower. So I am basically bullish about the market. I feel the stock prices will rise, so I have fixed a certain price already which is much lower than the anticipated stock price. And put options, I am bearish. I feel that the stock prices are gonna drop, right? And thus I buy a strike price which is much higher than the anticipated uh, price that can prevail in the market later. In the money, when if you when the option holder decides to exercise his right to buy or sell, and when would he decide to buy, to exercise his right? Only when it is favorable for him, only when he's making certain profit, only when there's a positive payoff for him. That's when we say that the option is in the money. Out the money, if exercising the rights associated with the option contract has no obvious benefit for the contract owner. So, in case of out of the money options, the holder of the option would rather forfeit his right and let the option expire as it is and not exercise it because it is not favorable for him. So, not favorable condition, out of the money, the right is not exercised by the holder. And for call options, this would be when the market price is below the strike price. What we are saying is, if I can get something in the market for a much cheaper rate than the pre-decided price, then why would I go with the option and exercise the option at the strike price? I would rather buy the underlying in the market itself because the market price is much below the stock price. So there is no benefit for the holder of the option to exercise his right. And in case of put options, when would it be a out of the money situation? When the market price is above the strike price. So if I have the put option, that means I'm the holder of the put option, I'm long on put, and if the market price is much above than the strike price that I have in the option contract, then I would rather sell in the market at a higher price than exercise my option and sell at a strike price which is much below. So, not favorable for the holder of the contract to exercise the option, and that situation is out of the money. At the money, when the stock price is equal to the strike price and it does not make a difference at all. Whether you exercise the option, not exercise, does not make a difference, does not give you any profit as such. Moving ahead. Now, this I call a very important slide, and generally from exam point of view, what you're asked to do is make payoffs for the calls, and accordingly there follows a question. So let's start with this slide. Here what we are doing is that we have these payoff diagrams, as you can see, for each of the positions. For if you are in long on call, if you are short on call, if you're long on put or short on put. These are the only options, right? I told you in a call option, somebody would be the holder of the call option, somebody would be the writer of the call option. Here, somebody would be the holder of the put option, somebody would be the writer or seller of the put option. So I have the payoffs for all the four on one slide. Okay. Now, the x-axis that you see here is denoting the underlying prices, and the y-axis that you see here is depicting your payoff, or you can say potential profit and loss values for the position that you hold. Okay. Now, let's talk about the call option first. Okay. Call options tend to be purchased by investors who hold a bullish view on the underlying. While if you have a bearish view, then you would probably buy a put option. And when you talk about the option writers or the option sellers, the option sellers will always have converse payoff profile to the option buyer, and the sum of the payoff for this person, so whatever this person is gaining, this person is losing. So the sum of the position of the buyer and seller is zero. Here the buyer of the option is this, the seller of the option is this. Option could be, buy of buying, which is call, of selling, which is put. So what I'm trying to say is that the maximum profit and maximum loss are interchanged for the buyer and the seller, but the break even remains the same. Let's talk about long call. So initially we say whenever anybody is uh, uh, going for a long call, they have to pay a premium to the person who is short on call, who is writing the call. Thus, you see this line here, which is on the negative side. So, this is the premium that has already been paid, and this is the equal amount of premium that is received upfront by the writer of the call. Simply put, what are we saying? We are saying that initially buyers of the option, be it be call option or put option, the buyers, the people who are long, they pay out a price of the option, and the people who are the sellers of the option or the writers of the option, be it be the call option or the put option, they receive the price of the option. Thus, this line that you can see here in long call is of the premium paid by the buyer of the call option. This is the premium received by the seller of the call option. This is the premium paid by the buyer of the put option. This is the premium received by the seller of the put option. Okay. If you come to value, the value of long call would increase as the value of stock increases. So just coming back to the what I just said about the premiums. If you look at one more point that I want to add to the premium part is that for the person who has paid the premium, the person who has the right, the person who is the buyer of the option, that means the person who is long call or long put, their risk is limited to the premium paid, because what is it that they have to lose? Only the premium. If they wish to exercise the option, they can. If things do not turn out favorable in time, then they don't have any obligation, they have the right rather, and they can choose not to exercise the option. Thus, their risk is limited to the premium they have paid. Whereas if you talk about the risk of the people who are short on the option or who have written the option, the writers or the sellers of the option, their risk is unlimited and their reward is limited to the premium that they have received. This premium, in terms of reward, they get upfront only. Now, about the payoff diagrams here, they are explained much more in the upcoming slides with examples. So, I'll take that discussion in the upcoming slides. What I have here in the blue box, that the easy way to remember these diagrams is to think of a diamond. So if, because generally there is a question where you're supposed to make a payoff diagram and the numerical part also is to be done, which we'll see in the upcoming slides. So just not to get confused, this is a small hint out there that if you think of a diamond and remember that left side is the call side whereas the right side is the put side, it becomes a little easier for you to remember. Now, if you look at this table down here, this is again a very important table. And what I've tried to done here is I've tried to summarize everything about the payoffs in this table. So I'll take you through this and then we'll move forward. The positions can be long or short, right? Either you could be on the buying side or the selling side of the option contract. And the product is call or put. Right? If you're long, you're the option holder, you have purchased the option, right? If you're short, you're the option writer, you've sold the option. If you are long the call, that means you have the right to buy because you're the option holder. All the option holders have the right, whereas option writers have obligation. Option holder, right, option writer, obligation. Here you have the right to buy. Here you are obligated to sell. Right to sell and obligated to buy. Because if this guy, the person who's in long call, exercises his right to buy, then the other party, which is short on the call, is under the obligation to sell. Right? If you look at the market outlooks here, the person who's going long the call is extremely bullish of the market and they believe that the market prices will rise. Whereas obviously the person who's writing the contract, who's short on the call, would have a different perspective of the market. They believe that market is more of bearish in nature. Similarly, person who's entering a long put believes that the market is gonna get bearish, whereas person on the other side of the deal, the person holding short put would have a bullish or neutral kind of market outlook. I think that's clear. Now let's look at break even at expiry. You know what is strike price, you know what is premium. First of all the long people who are in long position, they have to pay out the premium, and people who are short the position receive the premium, right? Thus the premium component is here. So for me, if I am, let's say, long call, I would exercise my option if the value of the stock in the market rises. To until which point would it rise, and then I'll exercise my option. It is not only strike price, but it is strike price plus premium paid. Why? Because I've paid this out of my pocket, and thus it gets attached when I'm talking about break even. Strike price is the pre-decided price that we have in the option contract plus the premium that I have paid. And you should always remember that the break even points are always the same for the other side, other party on the option contract. So if long call break even point is strike plus premium, the person who's short on the call would also have the break even at strike plus premium. Let's look at long put and short put. For them, the person who is long the put, for them, what we say is that the value of long put decreases as the value of stock increases. Though this person has also paid out the premium, so you can say that they would also want their premium to be added. But in the upcoming slides, I'll just show you and you'll come to know why this is strike price minus premium paid. So the break even position for put products is strike price minus premium, whereas for call it is strike price plus premium. Risk and reward columns have already been explained to you, where we have seen that the person who is in the long position, their risk is limited to the premium paid, whereas person who is in short position, their risk is unlimited. Person who is in long position, their rewards are unlimited, whereas person who is in short position, their rewards are limited to premium received. Margin requirements, generally the people who are in short position have to maintain the margin. This does not is of no relevance to you as of now, so let's not go deep into this. Moving forward now, we have this slide dedicated to the example of long call, and then we'll have a payoff and the diagram as well. So let's see. First thing first, when would you go for long call? You would go for long call when you expect the underlying asset to increase significantly in a probably relatively shorter term period. And why is it beneficial? Why is this strategy good? Because the risk is limited to the premium or the cost of the call you pay, no matter how much the underlying asset drops, right? And it also gives you the flexibility to select risk to reward ratio by choosing the strike price of the options contract you can buy. So some things to look at first are, I mentioned these 3 points here: strike price slash exercise price. This, why I've made this particular box is to acquaint you with the terms that can be there in the questions so that you don't get confused. These are some terms that are used interchangeably. So strike price or exercise price mean the same thing. Then there could be the term initial price or option premium or option price, same thing. Then underlying price or current market price or spot price at expiry, again the same thing. So these are three different things with their different interchangeable names given here. Strike price or exercise price can be denoted by an X, generally denoted by an X in a lot of equations if you even refer to your book. The option premium, because it's the option premium on a call option, we are denoting it with a C, and spot price by S. If you are in long call, simply first, before going to the example, if you are in long call, what you are saying that you believe the value of the stock will increase. When will you exercise your long call? Only when the market price is more than your strike price. Only when the spot price at expiry or the market price is more than the strike price will you exercise the option. If your current market price is less than or even equal to your strike price, you would not exercise the option, or in case it is equal to, you might, but you are basically, in case of is equal to, you are indifferent. So What are the payoffs in those specific scenario? Let's have a look. If the option is not exercised, then what is it that you're losing? Just the option premium minus C. That is the net payoff, nothing else. Now, if the option is exercised, when the market price is more than the exercise price, what is the net payoff? The difference between the spot and the exercise price, that, and minus the premium. Correct? So now, having that in mind, let's come to the example. What am I saying here? I'm saying that current ABC Limited price is 8200. This is the spot. The strike price is also 8200. Premium paid is 60 rupees. So break even point would be strike plus premium. You would want to trade at least at this point or a point beyond this when the prices go above this. And the lot size is 75. In somewhere in the very initial slides only, I had told you that we deal with lot sizes and not uh, single or individual shares. So we multiply our respective figures by the lot size, right? So now what they're saying is that the stock is trading at 8200 and the strike price is 8200, is trading at an option premium of rupees 60. And obviously you would be expecting a increase in the price. That's why you're going for a long call. So what are you going to pay in terms of premium? You will pay 75, which is the lot size, into 60, which is the option premium. This is the amount, 75 into 60, 4500 you will pay upfront to enter into a long call. And thus you have purchased single call option covering 75 shares. It's a single call option. This is a lot, right? So if ABC rallies to 8300, it goes anywhere beyond your break even point, then you will immediately sell in the open market for rupees 100 per share, because the strike price was 8200. Now the price of the underlying asset has gone to 8300. So you will immediately sell in the open market for rupees 100, because first you will buy at 8200 as per your strike price and then sell at 83. So basically you're making 100 rupees profit. And because the contract has 75 shares, the total amount that you will receive will be 75 into 100, 7500. You're receiving 7500, you had paid upfront 4500. So your net profit is 3000 rupees. Let's go over it once again very quickly. Simply put, what are we trying to say? अगर आप लॉन्ग कॉल में हैं, आप एक्सपेक्ट करते हैं कि आगे आने वाले टाइम में मार्केट में प्राइसेस बढ़ने वाले हैं. सो इसके लिए आप क्या करते हैं? आप चाहते हैं कि आप एक पर्टिकुलर प्राइस ऑलरेडी बांध लें कि अगर कल को मार्केट में प्राइसेस बढ़ भी जाएं तो आपने जो एक पर्टिकुलर प्राइस खुद के लिए बांधा होगा, आप उसी प्राइस पे खरीद पाएं, विच इज़ योर स्ट्राइक प्राइस, राइट? अब जब भी आगे आने वाले समय में मार्केट में अगर किसी चीज़ का दाम बढ़ रहा है एंड आपका स्ट्राइक प्राइस उससे कम है, तो आपको वो डील करने में फ़ायदा है. अगर मार्केट का प्राइस ज़्यादा है और आपने जो पहले से फिक्स किया हुआ था प्राइस, स्ट्राइक प्राइस, जो ऑप्शन कॉन्ट्रैक्ट में स्ट्राइक प्राइस लिखा हुआ था, अगर वो कम है तो आपको फ़ायदा है. क्यों? क्योंकि मार्केट में वो चीज़ मे बी 100 रुपये की मिल रही है, बट आपके स्ट्राइक प्राइस क्योंकि 50 रुपये है, आपको वो 50 रुपये की मिल जाएगी. वो आपको फ़ायदा है. आप जैसे ही वो 50 रुपये की खरीदोगे, आप मार्केट में फिर उसे ₹100 की बेच सकते हो, क्योंकि मार्केट में दाम ज़्यादा चल रहा है. दैट इज व्हाट इज लॉन्ग कॉल. एंड द कॉन्सेप्ट ऑफ ब्रेक इवन पॉइंट, इसमें हम क्या कहना चाह रहे हैं कि एक तो स्ट्राइक प्राइस को तो हम देख ही रहे हैं कि जो मेरा मार्केट का प्राइस है वो इससे ऊपर जाए तब मुझे फायदा है, प्लस एक प्रीमियम को भी देखा जा रहा है, क्योंकि प्रीमियम वो पोर्शन है जो हमने दिया है लॉन्ग कॉल में एंटर करने के लिए. ये मेरी जेब से गया है. सो हम चाहेंगे कि जो मार्केट में दाम जाए वो इस पॉइंट से ऊपर जाए, ताकि हम ऑप्शन को एक्सरसाइज कर सके और हमें फायदा हो. अगर आप इस क्वेश्चन को फिर से देखेंगे, हमने कहा था कि करंट प्राइस जो मार्केट का जिस वक्त ये ऑप्शन कॉन्ट्रैक्ट में एंटर किया कर रहे हैं उस वक्त प्राइस 8200 है. स्ट्राइक प्राइस जो तय हो रहा है प्राइस कॉन्ट्रैक्ट के लिए वो भी 8200 है. प्रीमियम ₹60 का दिया जा रहा है बाय हूँ, जो लॉन्ग कॉल में लॉन्ग कॉल खरीद रहा है, जो लॉन्ग कॉल होल्ड करता है. ब्रेक इवन पॉइंट विल बी स्ट्राइक प्राइस प्लस प्रीमियम पेड एंड लॉट साइज इज 75. हम क्या कह रहे थे कि एक तो जो पैसा दिया गया वो कितना है, वो हमने देखा 75 इंटू 60 है, क्योंकि लॉट साइज इज 75 एंड प्रीमियम इज 60. सो ये 4500 रुपीज दिए गए हैं बाय द होल्डर ऑफ द कॉल, विच इज द पर्सन हु इज इन लॉन्ग कॉल. एंड दूसरी हमने बात करी कि अगर देखा जाए कि मार्केट में दाम स्टॉक का हो जाए 8300, स्ट्राइक प्राइस था 8200, सीधा 8300 हो गया, यानी कि बढ़ गया. हमने कहा था जब भी जो हमारा मार्केट का प्राइस है ज़्यादा होगा हमारे स्ट्राइक प्राइस से, तो हमें फ़ायदा है वो ऑप्शन एक्सरसाइज करने में, उस राइट को एक्सरसाइज करने में. सो हम क्या कह रहे हैं कि अगर वो चीज़ मार्केट में हमें 8300 की मिल रही है, बट हमारे पास ऐसा कॉन्ट्रैक्ट है जिसके थ्रू हमें सिर्फ 8200 की मिल सकती है, तो क्या हम कॉन्ट्रैक्ट करेंगे? हम ज़रूर करेंगे वो कॉन्ट्रैक्ट. हम 8200 का खरीदेंगे, क्योंकि मार्केट में 8300 का प्राइस चल रहा है. हम 8300 के प्राइस पे मार्केट में बेच देंगे, हमें ₹100 का मुनाफा हो रहा है. हमारे पास 75 शेयर्स थे, क्योंकि एक लॉट खरीदा था हमने और एक लॉट में 75 शेयर्स होते हैं. द टोटल अमाउंट वी रिसीव्ड इज 7500. Something that we had already paid out of our pocket was the premium. So 7500 minus 4500 is 3000, which is our net profit for the entire trade for the person who is in the position of long call. I hope इससे आपको थोड़ा और clearly समझ आ गया हो. Let's move on to the payoff diagram of the long call. And इसी question को आगे follow करते हुए ये देखिए, ऐसे हम पे ऑफ स्केड्यूल बनाते हैं जब आपको एग्जाम में भी आता है. दैट इज हाउ वी डू इट. सो वी राइट द प्राइजेस, इफ दीज आर द पर्टिकुलर प्राइजेस एट विच द स्टॉक कैन क्लोज एट, एंड देन वी in one column write the net payoff, and also we make the payoff chart. पहले हम इसको देखेंगे. First let's have a look here and then we can understand the payoff chart, right? So what we are saying is that the break-even point was 8260. So at this point our net payoff will be 0, because this is the break-even point. अगर प्राइस इससे कहीं पे भी कम है, so हमारा क्या लॉस है? हमारा लॉस प्रीमियम पेड है, which is -60, right? And अगर 8260 से कहीं भी ऊपर है, तो हमारा क्या पे ऑफ है? हमारा पे ऑफ है द डिफरेंस बिटवीन स्पॉट प्राइस एंड स्ट्राइक प्राइस माइनस द प्रीमियम, करेक्ट? तो हम देखेंगे, जैसे हमने देखा था 8300 था जब हमारा प्राइस, तो हमारा नेट पे ऑफ यहाँ पे 40 आ रहा है. आप देख सकते हैं यहाँ पे जब हमारे पास 8300 का शेयर हो गया, 8260 was the break even point. 8300 minus 8260 is 40. This is that. So basically ये figures कैसे आई हैं हमारे पास? What we have done is we have put this equation, this formula here, that whenever the market price is more than your exercise price, what do you say? The difference between market price and exercise price minus the premium paid, the call premium paid. So that is how we arrived at these values, you can see. Now let's have a look at the payoff chart. I had told you earlier, x-axis is for the prices, the y is for the payoff or the profit and loss. 8200 is the strike price, 8260 is the break even, right? Anything below 8260 is our, basically we are losing on the premium. So this is a loss, the limited loss frame, we are losing to the extent of the premium. At the strike price itself, when it is equal to, I had said, here we become indifferent, right? We're still losing the premium because we have paid for it, but we become indifferent from this point onwards, from strike price onwards. And it starts, the curve starts moving upwards, but it's still touching x-axis at the break-even point. That means we are not making any positive profits till this point. But as it heads upwards from this price 8260, we will start making good profits. Profits are unlimited, losses are limited to the extent of premium. At the strike price, we are indifferent of our decision as to exercise the option or not. Though premium we have still paid, we're still losing on the premium part. You see, even at 8200 the net payoff is minus 60. So that is the payoff chart for your long call. Now exactly opposite to this position of long call or the call option holder is the position of the call writer or the short call. Short call is basically the writer of the call option, correct? And short call means that you are writing or selling the call option, and whenever you are a writer or whenever you are the seller or whenever you're short on a certain product, then you are under the obligation. In long call, we just did long call before this. In long call, the holder of the option had the right to buy, and if they exercise their right to buy, then the person in short call position would have to sell, would be under obligation to sell the underlying asset at the fixed price in the future. The fixed price is always the strike price, right? And why would somebody want to write a call option or get into the short call position? Because probably they expect that the asset price will fall, right? And what do they receive? They receive the premium, which is the reward, limited reward that they receive in the form of premium, but they are exposed to much higher risk if the stock goes up above the strike price. So also, if you look at the break even point and the net payoff, very much similar, but let's have a look at the difference. Okay, so this was your long call. We said that if the market price is more than x, more than the strike price, then the option will be exercised, and the net payoff for the person in long call would be the difference between the market price and the strike price and minus the premium that he must have paid. So if you look here, First thing first, this person is receiving the premium. So we don't have minus C, but we have plus C here. Okay. And as far as this portion is concerned, the difference between the market price and the strike price, we have a negative sign in front of it, which denotes that the net payoff exactly set offs. When we are talking about a person in long and person in short, their profit and loss, the sum of their profit and loss, the sum of their net payoffs would be zero. So exactly what this guy is earning, this guy is losing in those terms. So we have the minus in front, that's why. And again, if the option is not exercised at all, or whenever the stock price in the market is less than the strike price, what is what is it that the person in short call receiving? The premium part. So plus C. I hope you understand that how we take out the net payoff for a person who's short on the call. Now let's look at the example. What we are saying is that the current market price, Nifty current market price, now you see dealing on the index, because there are index options as well. So Nifty current market price is 9600. Sell ATM call at ATM means at the money. At the money call. Exactly. The strike price is same. Okay. Premium received is 110. Break even point would be the price plus the premium. Break even point remains the same for both parties. For person who's long, person who's short, the break even remains the same. Lot size is 75, right? What are we saying? We are saying, suppose Nifty is trading at 9600, call option with strike price of 9600 is trading at 110. And obviously, why would you enter into a short call? Yeah, because you're expecting that the Nifty will fall, right? You're receiving the upfront premium. What amount of premium are you receiving? 75 into 110. That's the lot size. So you receive the upfront premium of rupees 8,250 rupees, right? And this is the maximum amount that you will gain out of this whole option transaction. That's the maximum profit that you can gain, even if the option expires worthless. That is, the person in long call does not exercise his right to buy. Now let's say that Nifty falls or remains at, if Nifty falls or remains at 9600 by expiration, the option will expire worthless. Because why would the person who's long on call exercise? He would not exercise the option to buy, right? So no, in that case, the person who is short on call will not have any liability, and this 8250 will be the profit. This can happen in two scenarios: when the price falls or when the price stays the same. Loss will occur in one scenario when the underlying asset moves above the strike price sold. I think we're very clear about this because we've just seen the opposite side of it, long call. Let's have a look at the example payoff diagram and the table for the net payoff. So anywhere when your break-even point was 9710, that is where your net payoff was 0. Your profit is limited to the premium you received, which is 110. That is till the point of the strike price. As the price rises, there's a possibility that the other person, the person who's long on the call, will exercise their option to buy. And when they exercise their option to buy, then your net payoff will also change. What is the equation that we have used here? It is simply your this equation, which is minus s plus x. It will become plus. So it could be x minus s instead. It becomes your, either you can write it like this, or you can write it like, you can say that it's uh, your exercise price minus your market price plus the option premium that you have received. So using that, we've come to these figures, correct? If you look at the payoff diagram here, what are we saying? This, you're receiving something, so the line is up on the upward side, it's not on the negative side like we had in case of long call, because you're receiving the premium. So 110 is the premium that you are receiving, correct? Then this would be your strike price, which is your 9600. The price 9710, 9710 rupees is your break even. And the moment the price start going upwards of this, your losses start becoming unlimited. You will face a downward sloping kind of line. Why? Because you're on the short side. So the moment it crosses rather strike price, because from strike price to break even, that that is where the person is indifferent about whether to exercise the option or not to exercise the option. So from this point onwards, this is where you start getting unlimited losses the moment the price gets higher than the strike. So that is the payoff diagram for short call. Let's have a look at long put. Long put means buying a put option, or basically you are the holder of the put option. So when you're holder of the put option, you have the right to sell. And why would you, or when would you rather enter into a long put trade? When you feel that the price of the underlying asset will fall significantly in the upcoming period of time. So if you have that kind of market outlook, you would enter into a long put, the holder of the put option, right? Now, when will you exercise your put option? It will be exercised only when the stock price at expiration is lower than your strike price. And in that case, what would you do? The put option holder will sell the stock at the strike price, which would be higher than the market price, which has gone down. Because if the put option holder has to sell in the market, then the underlying asset will get sold at a lower price in comparison to the strike price. So that is when the option will be exercised, right? Also about long put, because you are the holder of the option, you have a certain right, you have to pay for the right, and thus you pay a premium. So if you look at the, again, the column here that we have, very similar to the one I had for the call option payoff. All the things remain same except the option premium. There it was denoted by a C because it represented call option premium. Here in put option payoff, it will be denoted by a P. So option premium for a put option. And like I just said, that the put option will be exercised when the stock market, when the stock price of the particular asset, of the underlying asset, will go below the exercise price. In this case, the long put will be exercised, right? So what will be the net payoff? The net payoff will be the exercise price minus the current price. That is one difference. So difference between the strike and the current price, and obviously minus P is denoting the premium that has been paid. If the holder of the put option does not exercise his option, then the only then the only loss that is there in his net payoff is to the extent of the premium that he is paid. Correct? Let's look at the example. What is it saying? So we are saying that current Nifty price is 8200, strike price is 8200, premium paid is 60. Break even price, remember, break even price is strike price minus premium in case of put. In case of call, it was strike plus premium. In case of put, it is strike minus premium. Does not matter whether you're long or short. So if you're long put or short put, the break even will remain the same. In case of put, do remember that break even is always less than the strike price because we are deducting the premium paid when we are considering break even point. So in case of long put, for the put holder, when we are saying break even for put holder is this, then we are saying that the price has to drop below this point, has to drop below 8140, so that the person in long put can make profits. So more it drops, more profitable the position becomes. Please remember the break-even point formula for put options. Then lot size is 75. Now what are they saying? Nifty trading at 8200, strike price again at 8200 at the premium or price of 60. Again, if the premium is 60, what do you pay up front? You will pay 75 into 60, which is 4500 to purchase a single put option covering 75 shares, and you are entering into this trade because you expect that the price of the Nifty will fall. Now let's say Nifty falls to 8100 rupees on the expiration date. So the basis of long put is that the put option, long put option will be exercised by the holder when the stock price is lower than the strike price or the exercise price. That's what we saw here, right? So if the price in the market has fallen down and the strike price is above that, the holder of the option will exercise his right to sell, and he will sell at 8200, making a profit of 100 rupees per share. We know we had a lot of shares, the lot size had 75 shares, so the total amount that he will receive is 7500, 100 into 75. And since he's the holder of the option long put, he must have paid the premium also. So what he's receiving, 7500 minus the premium amount of 4500, net payoff is 3000 rupees, the net profit that he makes on this deal. Let's have a look at the table and the payoff diagram here. So here you would see that 8140 was the break even point, right? And as the price increases from there, the option would not be exercised. The option is not exercised, and thus the loss is limited to the extent of the premium paid by the option holder, which was 60 rupees. Correct? So all the prices above the break even point, option is not going to be exercised. Option will be exercised for prices going down. So as the price goes down, the option holder will make money. How have we calculated this? You know already. If you look at the previous slide, this was how we calculated it. The net payoff, strike price minus the current market price minus the premium amount. So if you have a look here, that's how we calculated this. At 8100, the strike price was 8200. 8200 minus the current market price 8100 is 100, minus the premium of 60 rupees is 40 rupees. And that's how all these figures are calculated. To understand the payoff chart here, what do we have? This is the break even point. If the prices go beyond this point, then the option holder is not gonna exercise his option, is not gonna exercise his right. The more the prices go below this break even point, the more profit there is for the uh, put holder, the long put trader, right? And again, reiterating, option holder of put option will exercise his option as long as the stock price is lower than the exercise price, as long as it's in this area. Correct? And his profit is equal to the exercise price less the sum of stock price and premium. So that's why we said that the profits will start coming in from below the break even point. And what is the maximum gain that this put option holder can have when the stock price reaches zero, which is, I know, very hypothetical, but the maximum profit would be when the stock price reaches zero. In that case, what will be the gain of the option put holder? Put option holder. It will be equal to your, let's have a look here, just the exercise price minus the premium, because the stock price must have become zero. So in this case, what is the maximum profit that we can have? We can have the strike price 8200 minus the premium 60, 8140. The maximum profit that we can make. The column here can go up to 8140, right? So that's the maximum gain. If you talk about the maximum loss, that is to the extent of the premium paid only, which is 60. Remember, in long put, the option will be exercised if the price goes below the strike, not higher than the strike. If the price is going higher than the strike, then the option is not going to be exercised. It remains as it is. Let's come to short put. Obviously, we have discussed long put. Somebody would be holding the put option, would be buying the put option, and the other party on the same trade would be the person who's selling the put option, or writing the put option, or shorting the put option. So short put, be it be any put, you remember your break even remains the same. About your net payoff, because you're short the position, you receive the premium, thus the P is in plus in both the scenarios, when stock price is less than the strike price, and when stock price is more than or equal to the strike price. Premium in both scenarios is positive because you're on the receiving end of the premium. About this portion, the difference between the strike price and the market price, if you have a look at this previous slide, this is how we had the net payoff equation in long put. In short put, we'll just have a negative sign in front. Why? Because we know that the sum of the net payoffs becomes zero. So sum of net payoff of long put option holder and short put option holder has to become zero. Thus we have a minus sign here. That's how we calculate the net payoff, right? Now somebody who's short put is definitely the opposite of long put, and with this option strategy you are under the obligation to buy the underlying security, because long put person would has the right to sell. So you are under the obligation to buy the underlying security at a fixed price in the future, and it is suited or best suited when you expect that the asset price will rise in the future. Only then would you write a put option, or you will go short on the put when you are expecting that the asset price will rise. Since the position of option put option writer is exactly opposite to that of option holder, put option holder, and we know that the put option holder will exercise the option if the stock price goes below the exercise price, right? And in this position he will exercise the right, his right, and he will make profits, but at the same time the person who is who is on this side, who is short on put, will make equal amount of losses. So when stock price is higher than the exercise price, the option will obviously lapse, will not be exercised, and its value will be zero. But at that point the person who is short on the put will just make profit to the extent of premium, right? Let's have a look at the question that we have here. So current Nifty price is given 8300, strike price 8200, premium 80, break even we know for put is strike minus premium. It becomes 8120, lot size is 75. What we are saying is that if you expect that the price will surge, so you will sell 8200 strike and receive upfront profit of 6000, which is 75 into 80 here. The lot size into the premium receive. That is the amount of maximum profit that a person in holding short put can make, right? Potential profit is to the extent of premium, potential loss is unlimited, because the lower the stock price goes, the greater will be the loss to the short put or the put writer. So let's have a look here. What is it saying? It's saying if Nifty increases to 8400 or higher, options will be out of money at expiration and therefore expire worthless, and the maximum profit will be to the extent of premium. Now here it says that if Nifty goes against your expectation, whose expectation? The option writer's expectation, basically the put option writer's expectation. What is this person's expectation generally? Why do they enter into this kind of trade? Because they feel that the prices will rise. So against the expectation means that the prices are falling down, and what they're saying is that the price falls to 7800. If this is the scenario, obviously the other side to this option contract, the party on the other side, the holder of the put option, long put, would obviously exercise their right and make a profit, but this guy will have losses. So they are saying if the Nifty goes against expectation, falls to 7800, then the loss would be to the amount of 75 into 320. 75 is the lot size. How did they calculate 320? Through this equation. So if we uh, kind of rearrange this, we can write S minus X, right? S minus X plus P. So what are they saying? S has become 7800. 7800 minus strike price, which is 8200, which is minus 400, minus 400 plus the premium, minus 400 plus 80 is minus 320. So loss of 320 on each share, 320 into 75, 24,000. That is the loss that this person will have to bear if the prices drop. So it's basically put option writer is exposed to losses if the stock prices decreases. Let's have a look at the table here and the payoff chart here for the uh, put option writer. So what are we saying? If the price is above the break even point, then it is a profitable situation for the put option writer and profit to the extent of the premium received. At break even point, indifferent situation, so the net payoff is zero, no profit, no loss. Anywhere the price goes below the break even point, the put option writer starts having losses, and these losses can go to the level of unlimited. If you look at the payoff chart here, what are we saying? Break even 8120, right? This is the strike price. Any price higher than this is the portion of the limited profit. Profit limited to the extent of the premium. Anywhere the price goes below 8120, the losses to the extent of unlimited losses will start happening to the person who is the put option writer. And that's it for options derivatives. That's where we end with this chapter.